Welcome back. You've tuned into Midcap Masala right here from the Suzlon studio at ET Now. This is that part of the show where we bring on another management, as promised, Dr. Agarwal, Dr. Adil Agarwal, CEO of Dr. Agarwal's group of eye hospitals, here to break down their first quarter numbers with us. Dr. Agarwal, it's great to have you on board with us. Thank you so much for joining in on ET Now. I just want to run through the numbers first. In the eye hospitals, you've seen quite a strong quarter on revenue and profit, but EBITDA margin actually came down year on year. Can you help us reconcile these numbers and help us understand what's driving that gap between the headline numbers?
Hi, firstly, thank you for having me on the show. So I'm happy to share that, our revenue from operations grew by about 26% year on year. And our EBITDA margins grew by 25%, while our PAT has grown about 44.5%. Just a small correction, I think our EBITDA margins have actually moved up from 28.2% EBITDA margins to 28.5% EBITDA margins. So there's actually been a 0.3% improvement in our EBITDA margins compared to last year. The difference is, if you in our business, it's important for you to compare the business year on year versus quarter on quarter, because there is a lot of cyclicality in our business, which is why we always like to compare how we have performed this quarter versus the same quarter last year. So there's actually been a 0.3% improvement in our EBITDA margins compared to last year.
Understood. Okay, so that's the take on the way your first quarter has shaped up. I was just looking at your numbers, Dr. Agarwal. First of all, hi, this is Nehi also joining in. And the greenfield drag has been quantified at around 20 crore rupees at the corporate EBITDA level this quarter. Now, with 18 new facilities launched just in the quarter gone by, how much bigger could this drag get before it starts to ease as the centers mature? Can you give me a little bit color on the timeline that it takes for these centers to mature?
So the way we look at these centers is it's important to look at, dividing these new organic centers that we launch in our core markets. We consider markets where we have been present for at least 5 to 6 years, markets where the brand equity is strong, markets like Tamil Nadu, Andhra Pradesh, Telangana, Karnataka. Now we even consider Maharashtra to be a core market. In these markets, the path to break even is anywhere between 9 to 12 months. Whereas markets which we consider non-core markets, markets like Delhi, Gujarat, West Bengal, where we've not been present for that long, where the brand is still growing, those markets take about 18 to 20 months to break even. So the way we do our expansion is, we factor in most of our expansion into our core markets, while simultaneously we take some bets in non-core markets as well. So if you look at our expansion strategy, about 65% of our greenfield expansion will happen in our core markets between these 5 to 6 states, and the remaining 30 to 35% expansion will happen in non-core markets. That is one of the reasons why we have been able to kind of maintain our EBITDA margins despite this scale of expansion.
Got that, Dr. Agarwal. Can you also highlight on what sort of non-core markets are you looking to expand further into? And what does it take for a non-core market to then transform into a core market for you?
So, this is obviously based on experience, given that we have been expanding over the last couple of decades. The non-core markets that we are actively exploring right now is obviously Delhi NCR, which is a huge market, along with Haryana. Punjab is a market where we entered 4 years ago, and there also we're looking at expansion. We opened a new facility in Ludhiana. In the last 1 year alone, we have launched 8 new hospitals in Delhi NCR. Our plan is to open another 8 to 10 facilities over the next 12 to 18 months. UP is a market also that we recently entered. We have 1 facility in Lucknow and 1 facility in Varanasi. Along with this, we are also looking at adding a couple of centers in Kolkata as well. So I would consider these to be our non-core markets. We are getting better as we continue to do good clinical work in these markets. So we are hoping that over the next 2 to 3 years, as the brand equity builds, as patients start to trust our brand, we're able to provide quality clinical outcomes. The path to break even shortens, and they will start to function at the same level as some of our core markets.
Understood. Dr. Agarwal, due to paucity of time, I'm going to have to cut this conversation short. But before I let you go, there's one question I really wanted to ask you, and that's on the recent stake sale by some of your FII investors. And, multiple block deals is something that we've seen recently. Just trying to understand, is this simply financial investors monetizing gains? Does this signal anything about the company's ownership structure going forward?
So nothing changes from company ownership structure. So the promoter family continues to hold the 32.5%. Our private equity investors who have been invested for some amount of time have monetized a small percentage of this. I think now the good thing about this block deal is we've managed to bring in marquee domestic mutual funds such as ICICI Prudential, which has taken a large part of the block. Along with this, we have seen participation from other domestic mutual funds such as Invesco Mutual Fund and Motilal. Along with this, some other FIIs such as Polar Capital and Investec 91 also took a decent position. So I think this is great for the company because this diversifies your shareholding across different investors. Also, it helps increase your float, your free float, and also improves your trading volume. So I think all of this augurs well for the company, and this will help us improve our returns for our shareholders over the years to come.
Dr. Agarwal, very quickly, the merger of the eye hospital into the parent company on track for mid-November. That was the timeline you were tracking?
Yes. So our merger is on track. I think one of the big things last quarter was that we got shareholder approval for the merger. Now we are processing this now with the NCLT. Once the NCLT approval comes in, then we should be ready to file with exchanges and have one listed company.
Okay, sounds good. And we hope to interact with you then and before that as well. Thank you so much, Dr. Agarwal, today for your time. Good to be speaking with you.
Absolutely. Thank you so much for having me here.
Thank you so much. On that note, viewers, we completely timed out on this edition of Midcap Masala from Merrill, me and the team that put this show together. Thank you so much for tuning in. Keep watching ET Now. Buy Now, Sell Now is up next.